Breaking news from the Fed. Let's get straight to Steve Liesman with the latest. Steve.
Yeah, we've been reporting every day since a week ago Monday the interventions, the liquidity offerings of the Federal Reserve, the New York Fed, and we do have the results this morning. 65.7 billion or 0.8 billion was submitted, and 65.8 billion was accepted. And the Fed is making available up to $75 billion for overnight repo operations. The stop-out rate, the lowest rate, 180, and the gap between the low and the high, 180, 184. So it looks like things are getting a little more normal. New York Fed officials said in interviews with CNBC they're continuing to watch and study the repo market to understand why the market's been trading outside of the range of the Fed funds rate, that is, without Fed intervention. They say the instability in the overnight lending market does not suggest any kind of credit concerns or underlying problems like it did during the financial crisis. But they're still trying to figure out why a rate that should trade closer to 2% traded above 7% last week and required the Fed to step in with what are now daily injections of up to $75 billion in overnight lending. Now, they're pointing to one particular area of interest. Why aren't the banks stepping in to fill the funding gap? Officials said they'd heighten their monitoring on Friday the 13th because of concerns about tax payments the following Monday. So it's not like they weren't aware things were going to get weird. What they expected, but what did not happen, is the banks did not step forward, raising questions about where the money is and why it's not getting into the repo market. Last week, the New York Fed announced daily $75 billion repo operations until October 10th, and then 3 two-week operations take place this week. They hope this will tide the market over for the end of the quarter, which is coming up, and that can get a little bit weird.